After 28 sessions during the day, we just wanted to make a couple points as it relates to this session. And as we focus on things such as social capital or the different themes, human capital at the conference, government leadership, etc., whereas this is about global capital markets, the success in global capital markets and meeting the needs of individual countries, individual regions of the world, determines greatly what the history of the world will be. A failure to succeed results in different directions of history. And when the wall came down in the late 1980s, in many ways, the world missed an opportunity to fully integrate and create an opportunity for success in what Soviet Union became Russia. The lack of success of capitalism in the Ukraine and the promises for the people has somewhat changed dramatically the history of the Ukraine. And where we find access to capital and global markets operating effective, and the individuals in those countries and regions of the world feel that they have an opportunity based on their ability, not based on who they know, who their parents are, where they went to school, their religion, their race, their gender, and that the capital markets can fulfill those wishes and opportunities, things flourish. So today we have a broad group of people representing from Rich Byrne, who's the president of Benefit Street Partners, part of Providence Equity, and formerly Rich led Deutsche Bank in many of the areas, particularly in North America and Merrill Lynch. Katherine from Alliance Trust Investments, Chief Investment Officer and CEO. Bob from Shenkman, one of the leading money managers of credit portfolios in the world, as Senior VP and Portfolio Managers. Brigitte, who's had many important responsibilities in her life at PIMCO and other areas, particularly focused on emerging markets, and today here in London leads Babson's efforts in that area, and Babson manages more than $200 billion. And Paul Taylor has, as the CEO and president, significant responsibilities, leading Fitch as one of the three major rating agencies in the world. So their views, their decisions, what they do has a major effect on the world. And at the moment, I'd like to maybe start with yourself, Brigitte, and talk a little bit about capital markets and emerging markets. This year, we're going to see really a net outflow of emerging markets. Emerging markets have been extremely dependent on foreign capital coming in and financing their economies in other places of the world. You have a very long history in this area. How do you see the development of capital markets, and particularly in emerging markets here?
The way we look into the development of the local capital markets is extremely important. And it should be actually in the top agenda of most of those government authorities in terms of thinking how to develop the local capital markets. And the answer is very simple. It really allows those sovereigns to manage much more efficiently their assets and liabilities, to be less vulnerable to exogenous shocks. And the reality is that we have actually seen the development of several local capital markets in emerging markets, and they're in different stages of development. And a lot has to do with first what we have seen in '97 during the Asian crisis that actually promoted a lot of those countries to focus on the development of their own local capital markets. But that doesn't come overnight, and of course it's easier said than done. One of the things that one needs to look into it is the saving rates of those countries. It needs to look into how high those savings rates are, what is the gap between savings rates and domestic investments. And depending on the stage of development of those emerging markets, we will see a natural transformation and focus on development of local pension funds, insurance companies, and asset managers. Now, another important thing to consider when looking at the development of those local capital markets is actually the quality of the investor base. As I highlighted earlier, higher the savings rates in those countries, most likely that domestic capital market will be much deeper. And those are things that we have seen in countries such as countries in the Middle East, Singapore, for example, in which savings rates are north of 50%. But then you have countries such as Brazil, which savings rates are close to 15%, or even countries in sub-Saharan Africa that are much lower. And what that means is, yes, those countries can have a local capital markets, but they are much more dependent on financing their local bonds, much more dependent on non-residents. And those non-residents might go back to your question on potentially creating a shock in cases of stress in the market. And when we think about the Fed and potential hiking rates over the near term, that could provoke some portfolio outflows, either from non-residents as well as from residents.
So if we take a look, and we're now talking 7 years after the global financial, quote, crisis, and you take a look at the assets of the 4 largest banks as a percentage of GDP. So this would be some measure of the future risk to a country of the size of their banks relative to the GDP of their country. And we're all fully aware of what occurred in Ireland, where the losses actually equaled the GDP of the country. So Switzerland, the UK, France, Spain, and so on in Canada still are bank-driven in so many ways, capital markets, where the assets of the top 4 are substantially larger than the GDP of the country. And if you look at, for example, France, where the assets of the top 4 are 2.5 times the size of the economy, as juxtaposed the United States, where they're 40%. So effectively 6 or 7 times larger. And when we step back to what you had mentioned, Brigitte, the Asian crisis that started in Thailand, if we look at Asia's banks today relative to the size of their economy, they also are very large today. And so these economies are so dependent on access to capital to banks and the banking system to drive their economies. And if we look back at the real change in the United States that began occurring in the mid-'70s, we are 40 years later since when these changes started to occur, and they really have not significantly changed in Europe to date or have changed in Asia from that standpoint. Paul, what is the future for, in your view, for, say, European or Asian capital markets as you step back and think about that? And also, Paul, how does this reflect your thinking on rating, and will the capital markets eventually provide the financing and not make the economies so dependent on the banks?
Okay, thank you. Good afternoon, everybody. So I should start by saying I'm a believer in capital markets, which I guess I have to be given the job I do, but I'm a fan, a supporter of capital markets, of disintermediation of banking systems. And I think the reason I'm a fan is because it's a power for good in the world. I think it's a way of moving money around that creates value, creates growth. So I believe any development of capital markets, any deepening of capital markets has to be a good thing, has to be a good thing. America leads the way. It's the deepest, most sophisticated, mature financial and capital market globally. And I think many other regions in the world are beginning to move in the same direction. And the most important thing I've seen recently, apart from the trend of more companies moving to capital markets and disintermediating the banking system because banks can't afford to finance economic growth going forward, I've been really encouraged in the last few weeks to see the moves by the European Commission, which is really reflecting the drive for policymakers changing their view, which I'll come back to, but really to see the European Commission trying to get a dialogue going, a very difficult dialogue in Europe, going about creating a deeper capital market. That's a really, really positive thing and a fundamental change to the messages coming out of the Commission over the preceding 6 or 7 years. So I think we're generally through the crisis period. I used to go to dinner parties and say I worked as a tax inspector. Now I'm proud to say I work in capital markets. So I think we're coming out of the crisis. We're seeing markets develop and deepen and see the policymakers moving towards helping that dialogue. You know, securitization is no longer a dirty word. To see them going down that path in Europe is a really, really healthy and positive development.
Thank you, Paul. And if we take a look at slide 6, for example, we can see this dramatic change that occurred in the United States, where the blue represents the percentage of bank loans owned by banks changing over time in the United States. Now, there's been a lot of concern about different forms of investing that have occurred, the explosion in ETFs, open market bank funds, bond funds that are potentially available for redemption, different holders of securities, the enormous change in cash in corporations. If we go back to 07 at the start, the year before the financial crisis, Apple had $15 billion at the company. Today, it exceeds over $200 billion. If we pull up slide 8, we could take a look at that. In addition to that, it's not just Apple. GE, that had a liquidity scare in the fourth quarter of 08, has well over $130 billion in cash. Microsoft's cash, Google, and so on. And this isn't just limited to the United States. If we look at Japan, for example, today, you'll see the enormous buildup in Japanese companies. And if you look at it across almost all, quote, developing or developed countries in the world, you can see today their cash balances are substantially higher than they were a decade ago. So this liquidity, Rich, and I know when you were running many of these capital areas at Merrill Lynch and at Deutsche Bank, at that time, you didn't have buyers for your debt, in that Apple today has a $99 billion corporate bond portfolio. Oracle, $29 billion. Amgen, $16 billion. Johnson & Johnson, even General Motors, which went bankrupt a couple years ago, has a $7 billion corporate portfolio. How much at risk or volatility do these new forms of open-end funds for bank debt or bonds, Rich, or ETFs, or corporations buying debt, do you see affecting the market, and how are you factoring that into your own investment strategies?
So there's a couple of cross currents in that question. Let's parse them out one at a time. What is typically called the bank market, which, as we've all just pointed out, is in the U.S. is not a bank market at all, is it? It's really, more appropriately, a senior debt market, as you saw by the earlier slide of who owns the paper. It's virtually everybody other than banks, with a small sliver to banks. So the biggest player in that market are CLOs. Where this gets much more interesting is when we talk about the bond market, because that's much twitchier capital. But let's before we get off the senior debt market, CLOs. Now that's become a relatively stable investor base. For example, UCITS, which is a daily or sometimes weekly liquidity product, loans are not a qualified asset for that structure. So really, for the most part, the loan business, other than 08, which gets a big footnote, the loan business is, for the most part, a lot more stable because the investor base is more buy to own. The high yield market, or the corporate market, specifically where we think the most interesting opportunities are in the non-investment grade piece, that's a different story altogether. The vast majority of that buyer base is, as I said before, the twitchy capital, the ADD capital. It's mutual funds, ETFs. And now, all of a sudden, it's UCITS and other daily, weekly, fast twitch money that really goes not based on value all the time, but more on flows. And when you have capital that's based on flows, it creates a lot of volatility. Now, we've just gone through a 5, 6, 7-year period of relative quiet, thanks to the central banks in the US, Europe, everywhere else in the credit markets. Risk-free rate virtually zero. You haven't seen a lot out of the credit markets despite a lot of warning signs out there. Well, for the first time, the markets moved dramatically. And I'll say, we just looked it up. This conference last year, this very date, high yield bond index was at roughly, let's look at slide 1. High yield bond index was at roughly 6%. It's at almost 8% now, the index. But more interestingly, look at the dispersion. We haven't seen that in literally forever. Triple C's close to 14%. As I said, the index is a little over 8 at the time. It's rallied a little bit since then. But that's a major move. Why was there a major move? Was it because of change in perceptions about the Fed? Was it China? Was it Russia? Was it the Brazilian real? It could have been 1,000 things, but as the next slide shows, what it really came down to was energy. Energy. Look at that dispersion. The orange line is the energy index. And now, all of a sudden, the contagion effect is everything started following it. And the very simple reason for that is fund flows. Simply, you see enough downward price pressure in a certain sector, you start to get fund flows. And the fund flows have only gone one way for many years, and now all of a sudden they started going the other way. Maybe we can continue this in maybe some follow-up questions, but maybe it's just worth, before I end there, looking at the next slide. 9.3% of the market, as you can see by this chart, this is the highest, and if it goes all the way back to 08, where that would still be the highest. That's the percentage of the high-yield market that is considered distressed or stressed. Anything, the definition of this chart is anything 80 cents on the dollar or lower, 9.3% of the market. I'd submit to you that I don't think there's a lot of real fundamental change in the world other than in energy and other natural gas prices that are affecting this market so dramatically. But the fund flow effect on the heels of that, can create quite dramatic change, not just in energy, but as you saw on that first slide, across all the sectors.
And I think, Rich, as you have pointed out here, if 18 to 20% of the market a year ago was commodities, the real drop that has changed this and opened the spread and opened the distress levels are commodities. And I think one of the things that we've really focused on at the Institute over the years is an understanding of capital structure and how you finance a business. And understanding if your company is a commodity-based company, you can't really differentiate your product that well. And those companies needed to be financed with far more equity than debt in their capital structure. And unfortunately for many of them, they were leveraging up at the peak of prices today. So Bob, as we look at central banks, and if we pick slide 24 up, they have played a huge role in the marketplace. And those of us here, some of us remember when overnight money was 20% in the early 1980s, late 1970s. But as we can see here, they have driven rates down. And there's competition between different parts of the world who can drive rates the lowest. And obviously the US dollar has been exceedingly strong. One of the things we've focused on over the years at the Institute is if you knew the future, you'd be wrong. So if you were allowed to go and learn some facts, if you knew that China was going to sell over $100 billion of U.S. government securities, that Russia was going to be liquidating theirs, and so on, you would have normally expected interest rates in the U.S. to go up, and you would be wondering who is going to be buying these securities. But the exact opposite happened. Now, your firm at Shenkman has specialized in, if we want to call it, higher grade high yield, the double B, B plus segment of the market. How does the central bank affect your thinking when you sit around and decide how to invest?
Well, I think, the central banks have taken unprecedented action over the last several years since the large crisis, and you've seen unprecedented reaction to it, too, in the amount of refinancings, companies taking advantage of the low global interest rates. You would hope that certain countries that were more banking-based would take more advantage of this into the bond market so they had more diverse capital sources. But you've seen a massive flow of new financing come at much lower rates and a real push out of maturities. Now we've reached a point where the central banks around the globe are starting to go in different directions, or implying that they're going in different directions. The U.S. is clearly, it hasn't been talked about at all, actually, about them raising rates. But they're obviously considering raising rates. The UK, the Bank of England is obviously considering raising rates. I think European Central Bank is in a very, very different cycle. And some of this is creating a lot of volatility. Volatility can also create opportunities. We think that, the European rates are going to stay much lower. We do think that at some point, we're not going to try to guess when, but at some point the Fed will act. We actually think that there's a good chance that when the Fed acts, it actually lowers volatility. We think there's a lot of insecurity right now waiting for the Fed to act. There's certainly a lot of press space taken up about when the Fed is going to act. And the last 4 times the Fed has actually moved, which you have to go back pretty far, you have seen a decline in volatility, and that's usually good for the leveraged debt markets. So we think there's going to be an opportunity globally right now to take advantage of the different cycles within high yield, where you can be more comfortable extending duration. You're probably also earlier in the business cycle here in Europe. You may want to go deeper cyclicals over in Europe. Whereas in the U.S., you want to be a little bit more cautious about rates, even though we think any move in rates is going to be fairly benign, especially for a short duration asset class like high yield. But we do think that it's creating opportunity. To Rich's point, volatility has been certainly heightened by any measure in the last couple of months. A lot of it is technical. Companies away from the energy and commodities are continuing to report some good numbers, and we think it's created a lot of opportunity here, given where spreads are in the non-energy spaces within high yield, and also given where the default rate is and how low it is and what we're seeing from corporations. But as these central banks shift around and make their moves, it will create opportunities for investors and for companies.
Thank you, Bob. If we talk about volatility in the world, in many ways has been somewhat focused on the volatility of China. If we pull up slide 22, however, in many ways we all wish we had invested in the Shanghai market in 2014. So we've had significant volatility, but the market was around 2,200 January 1st, 14. Today it's around 3,200, so up almost 50%. And if we look at the U.S. market itself as a percentage on slide 25 of world stock markets and what percent it makes up of world stock markets, you can see there's been some pretty dramatic change due both to currency changes, but the strength over the period of time from 08, but still substantially below what it did at that time. So, Katherine, as we look at markets today, and if we pull up slide 26, the unbelievable volatility of commodities that's occurred and the unbelievable volatility of currencies. And with equity values in the emerging market falling by $4 trillion in a short period of time, how do you construct a portfolio, an equity portfolio, or your overall portfolios today to deal with this volatility?
Well, it's a really good question. And at Alliance Trust, we've been investing our shareholders' money for more than 127 years. So I think we've got a pretty good track record in this regard. And I think part of the challenge is trying to, frankly, divorce the short-term noise from the long-term opportunities. So we take, unsurprisingly, a very long-term view when it comes to investment. And we are almost as excited about the impact that our investments are making in terms of broader societal benefits as much as the financial return that we're making. And I think that, that's really what it's about. You have to look through the noise. And I think so often, particularly at gatherings like this, I find it deeply frustrating when people seem to confuse fiduciary responsibility with only focusing on the end of their nose, rather than actually looking at how you can do a better job for your investors over many years. So we tend to hook our investment philosophy and beliefs around a number of key core themes that have been in place for us now over the last 10 plus years. And they would include things like quality of life and climate change, just to name a couple. And I think that actually there is a huge opportunity facing us. I mean, you talked about some of the volatility, some of the key drivers of markets, and yet I'm surprised today that I've had so little conversation with people from our sector about the role that financial players and capital markets can bring to bear on the recently announced global goals at the UN. And if you think about it, it's very easy to say, well, addressing poverty, dealing with climate change, gender inequality, perhaps that doesn't matter to us. But what we're doing at Alliance Trust is spending a lot of time thinking about how we can sort of hook our core investment themes back into what we believe will be long-term themes stretching out probably beyond the next 15 years. And I think if we do that well, we will not only deliver good, less volatile, lower risk returns for our investors, but we will also be making a difference in a broader capacity as well.
Well, I'm very happy, Katherine, you're able to link goals in society with investment strategy. And one of the areas that we, because of our Centers for Public Health or our Center for Accelerating Medical Solutions, short name Faster Cures, or Center for the Future of Aging, we have been very focused at the Institute over the past few decades on what is the relationship between these and growth in the economies, and what are the drivers of that growth to the economies. And I know I've felt very strongly over the years that it is a market of bonds, not a bond market. It's a market of stocks, not a stock market. So today, I'm sure many stocks made an all-time high and many stocks made an all-time low. And it's interesting, if we pulled up slide 25, if we're concerned about imports to China, and we focus on here this volatility in the United States of what's going on in China, and then we look at slide 32. One of the reasons on a relative basis the U.S. has been strong is that the U.S. exports to China make up such a small percentage of the U.S. economy, less than 1%, that whether China is increasing or decreasing its imports. Now, Korea, on the other hand, a large part of their economy is dependent on exports to China. And so it's interesting when you look at things over time. If we picked up slide 31, and the areas that you talked about, Rich, commodities, it's easy to see here this unbelievable increase in iron ore. And if China is moving to more of a consumer from a manufacturing society, I think it's unrealistic to assume that type of growth expansion that we're looking at. And so this is an area that we're focused on. Let's switch to the other side. 4 of our panel members are responsible for managing billions of dollars of individual money, institutional money, pension funds, university endowments, insurance companies, universities' money, etc. that all have certain requirements for distribution and are dependent on the success of those investments. As we've discussed, many of you are managing money for people that have a 7% actuarial assumption. Brigitte, I'm assuming that if we gave the Milken Institute endowment to a good part of it to Babson, and we told you we need a 7% to 8% long-term rates of return, what would you be invested in today? And how would you structure it, and how would you advise us?
So looking to emerging markets, and I think all are aware of the last few months of the sell-off we have seen and the corrections we have seen, definitely on the credit side for hard currency, either sovereigns or corporates. And over the last 12 to 24 months, we have seen huge corrections on the currency front for emerging markets. Now, the question always comes, is it cheap enough? Are we going to see more volatility? Did we reach the bottom? And the reality is very hard to know if we reach the bottom. I think there's a lot of technical volatility, which moves independent of the fundamentals. And when we think about emerging markets, we tend to oversimplify and basically put more than 60 countries, more than 800 companies into one bucket, and basically also put 4 strategies into one investment strategy. So when you think about investing in emerging markets, I think there are definitely opportunities. Volatility will remain, and it will remain by obvious reasons that we have been discussing the whole day today: a lower global growth, a slower China growth, an environment in which commodities unlikely will have any catalyst on the positive side, and a weaker global trade. So with that backdrop in mind, one has to look for opportunities within emerging markets. And there are opportunities on the currency space, in commodity currencies, in commodity export currencies that got weaker than the products that those countries export, in which those countries were able actually to lower their imports and adjust their finance levels for the account deficits. There are enough companies within emerging markets in countries that are export-oriented, in countries that are import-oriented, that were part of the sell-off, in which the fundamentals are strong enough to navigate through this period of adjustment of a lower growth in emerging markets.
So you're suggesting that if money was given to Babson, then a good part of it would be allocated to emerging markets today. Is that a yes?
That's a yes.
Good. Yeah. All right. Katherine, what about yourself? What type of portfolio would you be constructing? We have a number of people who manage, are the chief investment officers of university endowments, insurance companies, pension funds with us today. How would you structure the portfolio to generate 7% plus rates of return?
Well, I would probably start by having a conversation about whether or not the endowment had a broader purpose in mind, as well as generating a financial return. I mean, we are predominantly a global equity house, so if you come to us, that's sort of what you get. We do manage a fair amount of money on behalf of endowments and very long-term investors. And what we typically do is engage in a conversation with them about what they're actually aiming to achieve on a broader level. So partly because of our investment philosophy, there are certain sectors that we tend not to invest in. So we tend not to invest in tobacco. We tend not to invest in certain parts of the energy sector. But what we absolutely guarantee is that we will, over time, give you better rates of return than mainstream benchmarks. And I don't think there are very many investors, particularly not in the UK, that could, with a high degree of certainty, tell you that our global equity portfolio emits 70% less carbon than the benchmark and is delivering you a higher rate of return.
So many of our, in our strategic philanthropy group that is focused on environment or other things, you would structure a portfolio based on their philosophy at that time.
We would be keen to build that in, because I think if you have strong alignment of interest between what the endowment is trying to achieve and what we can deliver, then I think that's a good partnership.
So, Bob, I'm assuming the rate today on the higher grade part of high yield is somewhere between 5 and 6.5 or 5 and 7. How are you going to generate 7 to 8%?
Well, I mean, you know, part of our DNA, our first job for you to be able to get higher returns is to preserve your capital.
So your first rule is not losing money is one of the best ways to get a rate of return.
Exactly. Fairly simple, but we live it and breathe it, you know, every day. Right now, I think probably the best way to get a rate of return, you know, we focus on below investment grade debt opportunities across the board. And I think one of the best ways to get a great rate of return, also preserve your capital and lower your volatility, is to have some flexibility in where you invest in those vehicles. I think if you are in an instrument that can move strategically between loans and high yield bonds, ideally between US markets and European markets, I think you can really enhance your returns. At the same time, I think adding a vehicle like converts can be extremely helpful. I think to lower the volatility, you want certain strategies in converts. Given our DNA again, our convert strategy really does focus on trying to minimize the volatility but capturing some of the upside. And I think being able to have some flexibility, given all the slides that you've shown about everything going on in the market, is really the best way to be able to enhance returns. And with a conservative philosophy, not lose any money on the downside.
So I know from the very beginning your firm had a policy that you would not invest in a company unless you met with the management. Is that policy still in place?
That policy is absolutely still in place. It's in place around the globe now, and it doesn't even come to our investment committee if we have not had a chance to meet with management. And if management stops communicating with us for any reason, it has to go into a full credit review, and usually will not come out well on the other side of the credit review. And it's not just a one-time conversation, it's a minimum of every quarter.
And I think one of the things that we learned in credit over the years is the importance of leadership as in anything, government, philanthropies, management of money, operating businesses, how important management is. Rich, what are the opportunities for many of the people here today to generate rates of return of 7 to 8% or better that you offer?
Okay, so let's take Bob's comments and take it maybe a little bit further. Volatility, technical volatility, for a opportunistic credit manager is a really good thing. So we've lived in the equivalent of the Sahara Desert for the last 6 years. We've just been in this environment. No matter what economic risk factor, macro factor has occurred, the market has pretty much shrugged it off. There's been some mini sell-offs, and they're really been characterized mostly as liquidity sell-offs. Really what happens is instead of the market differentiating and looking for the weakest credit to sell, you know, when there's a sign of trouble, rather the market look for the most liquid credit. And, you know, I'd characterize that as a first leg downturn. And then what typically has happened for literally 5 or 6 years in a row now is that was almost immediately followed, maybe it was a day, maybe it was a week, maybe it was a month, by a technical snapback of that same liquid name. So rule number two after focusing on return of capital, not return on capital, so rule number 2 is when you have conviction around the fundamentals of companies, particularly the higher quality companies, and they drop for no real reason other than technicals, you know, that's a buying opportunity. Now, what has happened since then, so this is sort of now that opportunity taken to the next extreme, is, as I described before, the market has had actually a legitimate capitulation. There's actually been some dispersion. You could look at it one way and say it was mostly just about energy and raw material prices, but the rest of the market has fallen. You know, yields are higher, and I'm talking about the U.S. And maybe there's some interesting lessons here because, you know, a lot of people view the credit markets as leading indicators, and certainly the U.S. is the biggest, most, you know, vibrant, you know, aspect of that, as you've seen on many of these slides, is, you know, how disintermediated it is and how it's really not a bank market. And those dislocations create even a sort of a second order opportunity, because then you have an opportunity to really pick through those triple Cs or, you know, things lower down in the capital stack and search for value. There are more needles in a haystack rather than sort of the value buying at the top of the capital stack, but there are opportunities. I think it's still too early for the distress cycle. Distressed default rates are something under 2%, depending on what you look at. In the United States, it's somewhere between 1.5 and 2. Europe is even lower than that. So, you know, we're an economy that things are sort of muddling along. We think the U.S. is a little bit more interesting, Mike, more directly to your question, than Europe. I think the risk-adjusted return, given how low rates are, that you're still in relatively early stages of monetary policy, and just sort of where you are in the cycle, I think the 6-ish% in Europe is actually probably pretty good, but the dispersion opportunities are finally starting to take place in the United States, and that's what we feed off. Now, before I just conclude there, let me just throw one more thing at you, so opportunity number one is take advantage of what the market gives you, particularly if it's not based on fundamentals, it's based on technicals. There's a lot of technical reason things are happening that bear no foot in reality. The other is regulatory. So maybe we can come back to this later in the discussion. I have a feeling these capital markets discussions usually head more in a deeper dive in regulation, but there's been such an incredible amount of regulation imposed in the US, in Europe, and everywhere, especially on banks. And banks have almost been forced to flee from certain very attractive asset classes. And you're seeing capital providers, like alternative capital providers, like many of the folks on this panel, take advantage of those opportunities, because all of a sudden, with bank capital out, that's a pool of money that no longer is there. That tends to create much better supply-demand balances.
Thank you, Rich. Paul, what an unbelievable assignment you have in rating and how to figure out. We often talk at the Institute about regression analysis that unfortunately so many people get wedded to in college, that assumes the future is like the past. And we've been very focused on education. I know when I visit countries, I always visit the schools to see what the future looks like. If we pull up slide 52, for example, we can take a look at this dramatic change that occurred in life expectancy in Asia, a 75% change in 2 generations that drove their economies, and not only an increase in life expectancy, but an increase in the quality of life. If we look at slide 54, for example, and just see the dramatic change. Asia, Europe, and we step back and look at what life expectancy was in 1900, 28 in Asia, 48 or so in Europe, 47 in the United States. By 1950, you had a 50% increase in Asia, continued increases in the United States, and in Asia today. So in a little more than a century, just imagine what's happened to a society where you've gone from life expectancy of 28 to life expectancy of 72. And if we step back, Paul, and take a look, say, at slide 33, our argument that human capital is a real driver of a business, of a society, and we take a look at these currency returns, where you see Brazil and others, Norway, that have dropped considerably in the last year or so, that are commodity-based, underlining the importance of non-commodity-based societies. If you just look at Norway, say slide 35, a country with the largest sovereign wealth fund, Brazil's volatility, but a country with the largest sovereign wealth fund's currency being so weak. How do you determine, and how can you determine the future? The volatility in currencies, the volatility in commodities. How are you attempting to factor these things and the volatility in the future from the disintermediation by technology. How do you sit around at Fitch and determine what the future ratings are, since that's dependent on whether people are going to receive interest or principal payments?
So we actually have a crystal ball that we keep in my office. Gives all the answers. So it's challenging. You know, we're predicting the future, or you're trying to assess what the future can be. So there are bound to be times when you get it wrong because you get your assumptions wrong. I think the big change in our industry has been moving towards more what-if type scenarios. So, you know, here's our base case. Here's what we think could happen. Here's what we think the forces are going to be and what the outcomes are going to be. But actually, if we're slightly wrong here or slightly wrong here, or this happens or this changes, you know, what impact would that have on the outcome of a credit rating? So I think we're doing a lot more. There's a lot more visibility around these kind of what-if and stress scenarios for people then to build out their own views. That's a healthy development in our industry. You know, back to your slides about aging populations, I think the really interesting point to me is that that's a really good example of the kind of dynamic that's going to drive capital markets globally. So I read something somewhere there's another 1 billion people moving into the middle income categories over the course of the next 5 to 10 years. So they're going to come with savings, with pension, with insurance proceeds. There was another very good report came out talking about total investment, institutionally managed investment funds moving from $60 trillion to $100 trillion. So a massive a growth in money available to be put to use. So to me, and then on the flip side, you've got the World Bank coming out with reports talking about the amount of infrastructure demand there is around the world, trillions of dollars of need for infrastructure spending. So if capital markets get it right, we can put that money to work in building roads and bridges in the US and in India and all these places. The most important thing to me is you have a policy framework that allows those flows to happen. And that comes down to the kind of regulatory topic that was brought up. It comes down to a policy framework that gives investors comfort that they know the ground rules. It encourages companies to come out and issue long-term debt. You've got to get it working. At the moment, it doesn't work. Particularly in Europe, it's not really working for all kinds of technical reasons. So getting that policy framework in place, which is the job of our political classes, is something that I think they're just beginning to come back to focus on because they've got over the anger of what happened in financial markets. So how that develops over the coming 5, 6, 7 years is a crucial topic in my mind.
Mike, can I go back to your regression
Sure.
comment for a minute? Because it's kind of a hot button for me. Probably was forced to take too many econometrics classes, but regression can be really dangerous in investing, and I think people really have to realize it. It's used all the time, and it's a valuable tool, and you have to use it. But think about the high yield market, and you know better than anybody else in the world how dynamic the high yield market is, and it changes. So when you're looking at statistics in the world that we live in, the market is completely different. You know, when I started, there were no tech companies in high yield. Now it's a huge sector. It changes constantly. So when you're trying to define the market, oh, this is how it acted in this cycle, this is how it acted in this cycle, we'll run a regression. You have to look at the components in it. And the components change constantly. And that's why in my world that we live in at Shenkman Capital, that bottoms-up research is so important because that's your best defense against making a mistake. And the regressions can really run you in the wrong direction. It's a very, very big hot button for me. I mean, if you look at we'll bring it back to energy. If you look at the energy companies right now, you can run all the data and say, oh, in other cycles, energy companies haven't done this, energy companies haven't done this. Our universe of energy companies is completely different. You talk about, I know one of your themes is disruptive technologies. Talk about disruptive technologies. I know it's not, you know, Silicon Valley and designer jeans and designer t-shirts. Fracking is one of the most disruptive technologies, and it affects everybody. You know, even countries that don't have Uber, and because it's changed the price of oil. And that you just don't get by looking at a regression analysis. So,
Thanks, Bob. I'd like to see if we can now change the titles of all of our panelists. They're moving from chief investment officers, CEOs here, et cetera. In the last few seconds, they've joined government. And they are now Secretary of the Treasuries, head of the European Community, et cetera. And let's start with you, Brigitte. You are ahead of a group of emerging nations. They have hired you. What type of things financially would most benefit, in your opinion, in the next few years, the emerging markets?
I would go back to the first point that we started. I think is implementing regulations that would develop the local capital markets, having the right balance between investors that are residents by, again, increasing saving rates in those countries. Easier said, of course, than done, but the right balance between residents and non-residents.
All right, so one of the things we're very focused on at the Institute is training people in emerging markets in conjunction with the organizations to educate them in capital markets and have them go back to their countries. So there's a call to action today by Secretary of the Treasury here, Brigitte, to have you, those of you from different countries, and I know we might have 30 different countries here, we want to make sure we've focused on developing markets in your countries, and it'll create some great economic growth. Rich, I know you are excited today about being able to work for a money manager and no longer working for a bank. But today we've appointed you as the Secretary of the Treasury in the U.S. What policies would you be pushing to increase economic growth?
Okay, so that's an easy one. Well, that's a good question. It's easy but good. I think of the regulatory regime as a pendulum. Okay, we went from light regulation to almost irresponsibly light regulation, caused a lot of financial products to exist and created, was in large part responsible, at least, for the crisis we lived through in 2008. And what was the regulatory response? Swinging that pendulum in the exact opposite direction. Volcker Rule, Basel regs, you name it, all the things, the bank leverage lending guidelines, which are basically imposing to banks what deals they can do based on a formula of leverage and not necessarily taking into account any of the touchy-feely things that really lenders thrive on. So the simple answer to the question is, let's put the pendulum somewhere in between where it was and where it is. Some of the best and brightest minds I've always found are attracted to banks and investment banks because over the years they've been very entrepreneurial places, and all the really great, interesting, cool financial innovations tend to have at one point come out of banks. And we have a system now that I think is devoid of a lot of that creativity. They've been structured or regulated to look a lot more like utilities. I think we had, when I was last at Deutsche Bank, I think it's probably even more now, Mike, but I think we had 60 members of the SEC, Fed, OCC, some combination thereof, with passes to get into the building, just in New York. That's not including the other locations, that literally were able to go in and out of any meeting they chose. All they had to do was announce themselves. Well, funny enough, all they had to do was announce themselves, and the meeting would go something like, "No business today?" Okay. But nonetheless, their job was to look for things to begin to investigate. That's not a way to go through life. They regulate how much money people can get paid. So granted, maybe we were an extreme before, we're an extreme now. Somewhere in between, I think, would lead to financial innovation. It would put interesting assets on banks' balance sheets. And if you weren't so focused on your Basel risk-weighted capital weightings and your Volcker tests for your own inventory, maybe banks would start venturing out into some of the emerging economies and some other interesting places to generate returns and generate interesting opportunities for their clients.
Thanks, Rich. And some of the major banks in the U.S. now have more than 20,000 employees just to deal with compliance, 20,000 employees. Katherine, we're going to really assign you here to Europe and the UK. What changes do you feel now that you are the exchequer that you would like to deploy?
Well, I think to perhaps wrap us up from a European and UK perspective, I would really focus on financial inclusion. I think that we've become afraid of saving. I think we need to educate people that saving is not a bad thing. We need to demystify the world of investment from our perspective. And I think if we can achieve all of those things, ultimately it will lead people to feel safer about their financial futures. And I think that therefore we will become much less dependent upon the state. And as the Chancellor for the Exchequer, I think I'd be pretty happy with that.
Well, we're very excited that you're in that position. You're going to be focusing on educating members of government in finance. Bob, as you look at the world today, if you were the Secretary of the Treasury, what would you be implementing to try to spur economic growth?
Well, I think one thing I would do is try to get fewer regulators involved. I think, I think that what some of the regulations that have been put in place in the world that I know best in finance have really damaged organizations with their social capital. It's forced a lot of quality people to leave. Not that there are not still some really great people there, but I mean, look at this panel. You were at a bank once, I was at a bank once, Rich was at a bank once, and I'm sure part of the reason we left was because the Treasury and control of the currency and the Fed all kept putting on more and more regulations, and too many people putting the regulations on. So you'd like to have it a little bit more simplified. The other thing that's huge in the U.S., but I don't know how it ever gets simplified, is a simpler tax code. The tax industry is a huge industry because of its complexity in our country, and taxes are used in punitive ways, they're used in progressive ways, they're used in regressive ways. It's just, there's no good regulation that is 3,000 pages long, and that would be the other thing. If I could do that from the Treasury seat, I would do that.
So, Paul, your position has changed from being the CEO of one of the three major rating agencies to the CEO of one of the largest banks in the world. What would you be telling your employees? How would you like, do you think, to move your financial institution to help economic growth?
So I was hoping to be a Chancellor or Finance Minister.
All those jobs were previously taken.
So I'd probably try and move to a rating agency. But, I don't know, it sort of echoes the theme we've just had, which is a lot of financial institutions are under pressure because of the regulatory changes that are going on. It's not different to our business. We've gone from being not regulated to being regulated, and it's come with a fair degree of pain, it's fair to say, both for in my level and also throughout the organization. It's a new world to get used to, a new way of doing things to get used to. The key theme for me, and this will be exactly the same message, I think, if I was running a bank versus running a rating agency, is we can't afford to let the regulatory environment detract from the quality of the product we have. So if it restricts people from giving their opinion, from having freedom of thought, from doing things that create a value product, then we really got to find a way to deal with it and a way to open a dialogue to change the situation we're facing. And I think you would have probably noticed along with me in the last several weeks, there have been quite a lot of commentary and discussions coming out of senior bank executives, particularly in Europe, about the playing field and how the fact it's not level and the challenges they have. So to me, it's all about dialogue. It's about having a discussion. And it seems as though policymakers are now more open to having that dialogue, albeit they keep slipping back into kick the finance industry because it's a quick public score. So I would be, if I was finance minister, I'd be trying to change the dynamics around how people think about finance. It's a valuable industry. It should be thought of as such. If I'm an executive in an organization that's regulated, I'd be trying to open a dialogue around that the pendulum probably has swung too far and it's not overly productive for future economic growth.
Thank you very much, Paul. And so in closing, I want to thank our panelists. And I just want to remind you, if we put up, say, slide 2, just how important access to financial capital is, the enormous challenge the world faces on creating meaningful jobs in the future. And one of the things we've so focused and want to work with you at the Institute is, can we create financial markets that help solve the significant problems of society? Our Financial Innovations Group many years ago, as a team, was interacting on how do we eliminate asset rain, and the creation by Richard Sandor, one of our senior fellows that we worked on, where we created these credits for sulfur dioxide in a matter of 10 years by being able to sell credits and being forced to buy credits if you couldn't reduce your emissions, eliminated about 95% of the problems. We feel very strongly at the Institute that working with you, we can create financial markets that will spur economic growth, create jobs, and solve many of the problems of society. So thank you for joining us. Thank you, panelists, today.
Thank you, Mike.